83. That is the number they hope you ignore. That is the number they want buried under headlines about fading war premiums and rising yields. That is the number that should make you stop whatever you are doing and pay very close attention. Today, silver touched $83. We began the week above 96. In less than 2 trading sessions, more than $13 per ounce disappeared from the paper price. That is over 13% erased almost instantly, while one of the most strategically critical waterways on the planet is under direct threat, and the Middle East stands at the edge of what could become the largest military escalation since World War II. Think about how absurd that is. A major energy choke point is being shut down, global tensions are exploding, and the so-called safe haven metals are being sold as if nothing is happening. That disconnect is not normal, it is not rational, and it is not accidental. Iran has declared the Strait of Hormuz closed. A senior advisor to the commander-in-chief of the Islamic Revolutionary Guard Corps publicly stated that the Strait of Hormuz is closed and that any vessel attempting to pass would be set ablaze by the Revolutionary Guards and the regular Navy. That is not rumor. That is not anonymous sourcing. That is an official statement from one of the highest-ranking military figures in Iran. Roughly 20% of the world's oil and gas flows through that narrow passage. 20% of global energy supply moves through that corridor, and a nuclear-armed adversary of the United States has said it is shut. Yet silver is plunging, gold is pulling back. The very assets investors are told to hold during geopolitical chaos are being liquidated, while the world stares at the possibility of a global energy shock. Does that align with anything you understand about how markets are supposed to function? Does it match what you were taught about risk, about capital preservation, about the behavior of safe haven assets in times of extreme uncertainty? It does not, because what we are watching is not clean price discovery. What we are watching is a paper market reacting to mechanical forces, not fundamental reality. Let us examine what actually happened. Silver opened the week above 96 per ounce. Futures markets reacted immediately to the escalation in the U.S.-Iran conflict. There was a gap higher as traders priced in geopolitical risk. Gold surged above $5,400. The war premium was visible everywhere. Safe haven flows were obvious. The tape reflected tension and fear, exactly as expected. And then the reversal began. Silver fell from $96 to just under $83, a $13 drop in under 2 days, approximately a 13.5% decline. As I speak, price is hovering near $86.50, attempting to stabilize, but the technical damage is clear. Momentum shifted. Near-term indicators rolled over. Gold retreated from above $5,400 to around $5,300. The 10-year Treasury yield climbed to 4.07%. The U.S. dollar index strengthened sharply as capital rushed toward liquidity. Financial media outlets immediately framed the story around fading war premiums, rising yields, and profit-taking overwhelming safe haven demand. Analysts began explaining the move with familiar language. One suggested that the flush lower that began earlier in the year had not fully completed, and that further volatility could emerge on any recovery attempt. Another pointed to broken short-term momentum, noting that silver failed to reclaim its 100-hour moving average and slipped beneath the 200-hour moving average, shifting the near-term bias bearish. Others highlighted rising Treasury yields, arguing that higher fuel costs were intensifying inflation concerns and forcing traders to reconsider the Federal Reserve's rate cut timeline, with expectations shifting from July to September. That is the narrative being circulated. Silver is down because yields are up. Silver is down because the dollar is stronger. Silver is down because the technical setup deteriorated. Silver is down because speculative momentum reversed. But buried beneath all of these explanations is one undeniable fact. The Strait of Hormuz is closed. Understand what that means. The Strait of Hormuz is a narrow waterway between Iran and Oman, roughly 21 miles wide at its tightest point. Approximately 21 million barrels of oil pass through it each day, representing about 20% of global consumption. Massive volumes of liquefied natural gas also transit that route, supplying energy to Europe and Asia. If the strait remains closed and Iran follows through on its threats, the global energy market does not experience a minor disruption. It faces a structural shock. Oil does not simply climb to $100, it could surge to $200, $300, or beyond. European natural gas prices would not merely tick higher, they would explode. Supply chains that depend on affordable fuel would strain under immediate pressure. Inflation would not rise modestly, it could accelerate sharply. Central banks would not debate minor policy adjustments. They would confront impossible decisions between containing inflation and preventing economic contraction. This is not exaggeration. It is a logical outcome of disrupting the most important energy corridor in the world at a time when inventories are already tight. And yet in that environment, silver is selling off. Gold is pulling back. That contradiction only makes sense if you understand what is actually driving the paper price. Three forces are colliding at once, none of which reflect silver's fundamental value. First, the US dollar is rallying because global capital instinctively seeks liquidity during crises. This behavior is reflexive. It is about immediate access and transaction capacity, not long-term purchasing power. The same dollar that has lost roughly 98% of its purchasing power over the past century becomes the temporary refuge because it is liquid and widely accepted. When institutions need to move billions quickly, they buy Treasury bills, not physical metal. As the dollar strengthens, commodities priced in dollars often fall in nominal terms, even if their real value relative to goods and services is rising. Second, Treasury yields are climbing as energy prices rise, stoking inflation concerns. Higher inflation expectations suggest the Federal Reserve may delay rate cuts, keeping yields elevated. Higher yields increase the opportunity cost of holding non-yielding assets like silver, at least within conventional financial models. Traders respond mechanically. Algorithms trigger sell programs. Short-term speculators rotate capital. It becomes a reflexive cycle driven by models calibrated for a different macro environment. Third, and perhaps most significant, periods of maximum uncertainty create ideal conditions for stop-running and forced liquidation in leveraged markets. When volatility spikes and liquidity thins, large players can push price through key technical levels, triggering automated selling. Retail traders who place stop losses below support are forced out. Momentum traders flip short, fear compounds. Price cascades lower, detached from physical supply realities. This dynamic has existed for decades in futures markets. It is amplified when headlines are chaotic and investors are unsure what to trust. So when you look at silver trading near $86 after touching $83, do not assume the market has calmly reassessed geopolitical risk and concluded everything is manageable. What you are seeing is a paper mechanism reacting to dollar strength, yield movement, and leverage positioning. The physical market does not change overnight because of a futures sell-off. Mines do not suddenly increase production. Industrial demand does not evaporate. Long-term holders do not dump metal into the market because of a two-day correction. What changes is positioning. Contracts exchange hands. Leverage unwinds. Screens flash red. The key question becomes this: who is actually selling silver into a geopolitical escalation of this magnitude? Long-term investors protecting purchasing power are not likely unloading metal at that moment. Industrial consumers are not rushing to cancel orders in the middle of potential supply shocks. Sovereign wealth funds are not liquidating hard assets because yields ticked higher for 2 days. The selling pressure primarily originates from leveraged participants responding to mechanical triggers and from large institutional players taking advantage of volatility. That distinction matters, because when selling is driven by leverage rather than fundamentals, it does not create new supply. It simply transfers exposure. This is why the divergence between paper price and underlying risk is so striking. The market narrative focuses on charts and yield spreads. The fundamental backdrop centers on a strategic energy choke point and escalating military operations. When those two realities conflict, volatility follows. Today, silver's decline tells you more about positioning than about intrinsic value. And if you are trying to understand what comes next, you must separate mechanical price action from structural forces shaping the global economy. Now let us go deeper, because surface-level explanations are not enough in a moment like this. When markets move violently, most people focus on the chart. They stare at moving averages, support levels, Fibonacci retracements, and momentum oscillators as if those lines contain answers. And right now those charts look damaged. Silver has broken beneath short-term averages. The near-term bias has shifted. Momentum indicators have rolled over. Support zones that traders were watching have failed. On paper, the setup appears fragile. It appears as though a deeper correction is underway. It appears as though the market has made a clear statement that the prior upside momentum has stalled. But here's the critical point. Technical analysis assumes a normally functioning market driven primarily by organic supply and demand. When markets are dominated by leveraged derivatives, high-frequency algorithms, and institutions capable of deploying enormous amounts of paper contracts in seconds, technical signals can reflect engineered behavior rather than genuine sentiment. When large entities decide to push price through key levels, they do not require fundamental justification. They require liquidity and volatility. In times of geopolitical shock, both are abundant. Stops are clustered beneath obvious support. Retail traders place protective exits under widely watched levels. When those levels break, automated selling accelerates. What begins as a controlled push turns into a cascade. Price falls not because millions of investors reassessed the global energy landscape and concluded silver is worth less, but because risk management protocols triggered mechanical liquidation. That distinction matters enormously, because mechanical selling exhausts itself once leverage is flushed. It does not permanently alter the structural drivers of the asset. Consider what has not changed. Roughly 21 million barrels of oil still move through the Strait of Hormuz each day under normal conditions. That represents about 20% of global oil consumption. Liquefied natural gas shipments to Europe and Asia still rely heavily on that corridor. If even a fraction of that flow is disrupted for a sustained period, energy markets will not react mildly. They will reprice aggressively. Oil does not need to reach $300 to destabilize global growth. Even a sustained move toward $150 or $200 would strain economies already carrying high debt burdens. Energy feeds into transportation, manufacturing, agriculture, and virtually every sector of modern life. Rising energy costs are not isolated price adjustments. They ripple outward, embedding themselves in supply chains and consumer prices. Inflation, which markets believed was moderating, would accelerate again. Central banks would confront a scenario they fear most: rising prices alongside weakening growth. The 10-year Treasury yield already climbed toward 4.07% as traders recalibrated expectations. The market began pushing anticipated rate cuts from July toward September, reducing projected cuts from 3 to 2. That repricing weighed on metals because higher yields raised the opportunity cost of holding non-yielding assets. But this framework assumes the Federal Reserve operates in a stable environment where modest policy tweaks can fine-tune outcomes. A severe energy shock does not produce modest outcomes. It forces abrupt trade-offs. The Federal Reserve cannot easily raise rates into a war-driven energy spike without risking a sharp downturn. At the same time, cutting rates aggressively into accelerating inflation undermines currency credibility. Holding steady while both inflation and unemployment pressures build invites stagflation. This is the trap. History shows that when faced with systemic stress, policymakers prioritize financial stability over currency purity. Liquidity facilities expand. Balance sheets grow. Emergency programs are introduced. The language may differ, but the effect is consistent. More money enters the system to prevent cascading failures. Over time, that erodes purchasing power. That longer-term dynamic is precisely why precious metals matter. Yet in the short term, markets often react in the opposite direction because of liquidity preference. When uncertainty spikes, global capital gravitates toward the most liquid instruments. The US dollar benefits from that reflex, not because it is immune to debasement, but because it is the global settlement currency. Institutions can deploy and withdraw billions rapidly in treasury markets. They cannot transact that scale in physical silver overnight. So capital flows into dollars and bonds initially, strengthening the currency and pressuring dollar-denominated commodities. It is a liquidity event, not a value judgment. Now consider the physical dimension. Paper contracts can trade in enormous volume with little friction, but physical metal must be mined, refined, transported, and delivered. If the paper price drops sharply while geopolitical risk rises, physical demand often increases. Investors who understand the macro backdrop use corrections to accumulate. Industrial users concerned about supply disruptions may secure inventory. The visible spot price on a screen does not necessarily reflect the price at which real metal changes hands in tight conditions. Premiums expand, availability narrows, delivery timelines lengthen. These shifts are subtle at first, but they signal stress beneath the surface. Ask yourself again, who benefits from sharp paper sell-offs during peak uncertainty? Traders with leverage can profit from volatility. Institutions capable of absorbing contracts at lower prices can reposition for the next leg higher. Those without conviction often capitulate near the lows. Fear is contagious. A 13% drop in 2 days feels catastrophic, even if the asset remains multiples above prior cycle lows. Psychology drives decision-making more powerfully than spreadsheets. When headlines amplify phrases like fading war premium or deteriorating technical structure, doubt grows. But the war narrative itself has not disappeared. Military operations continue. Reports confirm command posts, air defense systems, and missile launch sites have been targeted. These are not isolated gestures. They represent sustained engagement between significant powers. Energy infrastructure sits within range of potential escalation. Shipping lanes remain vulnerable. Markets may temporarily shift attention to earnings, speeches, or data releases. But geopolitical realities do not vanish because traders grow bored. If an energy shock materializes fully, price adjustments will be swift. It is important to understand how quickly sentiment can reverse. Today, silver struggles near $86 after touching $83. Analysts emphasize broken support. Commentators debate rate cut timelines. But if oil surges sharply or a major shipping incident occurs, safe haven flows could reappear with force. The same algorithms that sold on dollar strength can buy on inflation spikes. The same traders who exited positions can scramble to re-enter. Short covering can amplify moves. When leveraged shorts rush to close positions simultaneously, price accelerates upward faster than fundamentals alone would dictate. Markets are non-linear. Corrections within broader trends are common. A decline from $96 to $83 is severe in percentage terms, yet it does not erase the larger structural advance from much lower levels. Volatility expands as assets climb into higher price zones. That is characteristic of powerful trends. Shallow pullbacks rarely shake out weak hands effectively. Deep, rapid drops often serve that function. Once leverage is cleared and positioning resets, trends can resume with renewed momentum. This is why separating time frame from thesis is essential. Short-term price action reflects liquidity flows, yield movements, and positioning dynamics. Long-term valuation reflects monetary policy, fiscal deficits, geopolitical fragmentation, and supply constraints. Those long-term drivers have not vanished. If anything, they have intensified. Energy insecurity compounds inflation risk. Policy constraints tighten. Currency debasement pressures remain embedded in structural deficits. None of this guarantees immediate upside. Markets can remain disconnected longer than participants expect. Silver could retest lower levels if volatility persists, but the underlying risk profile facing the global economy has shifted upward, not downward. When assets tied to monetary protection fall during rising systemic stress, it often signals forced liquidation rather than improved fundamentals. So instead of reacting purely to price, evaluate context. A 13% drop during escalating geopolitical tension is not typical of assets losing relevance. It is typical of leveraged markets repricing liquidity. The real test will come when physical demand meets constrained supply amid persistent uncertainty. At that point, paper positioning alone cannot dictate price. Reality reasserts itself eventually. The question is not whether volatility continues in the near term. It almost certainly will. The question is whether the structural forces building beneath the surface are weakening or strengthening. And when you examine energy flows, monetary policy constraints, and geopolitical risk together, the answer becomes clearer. Now let us talk about what this means for you, because none of this analysis matters if it does not translate into decisions. The market has repriced aggressively. Silver dropped from $96 to $83 in less than 2 trading sessions, roughly a 13% decline, and is attempting to stabilize near $86.50. Gold retreated from above $5,400 to around $5,300. The 10-year Treasury yield climbed toward 4.07%. Expectations for Federal Reserve rate cuts shifted from July toward September, with the market now anticipating 2 cuts instead of 3. The US dollar strengthened as capital sought liquidity. These are the facts. The question is how to respond without being controlled by short-term emotion. If you hold physical silver, understand what you own. You do not own a ticker symbol fluctuating minute by minute on a screen. You own a tangible asset that has preserved purchasing power across centuries of currency debasement, political upheaval, and monetary experimentation. A futures contract declining 13% in 2 days does not change the structural pressures building in the global system. The Strait of Hormuz remains under threat. Approximately 21 million barrels of oil, about 20% of global consumption, normally pass through that narrow corridor. Liquefied natural gas shipments that supply Europe and Asia rely on that route. Military operations are ongoing. Energy markets remain exposed. Inflation risks are not eliminated by a 2-day correction in silver. Paper price volatility does not equal fundamental collapse. It reflects positioning. It reflects liquidity. It reflects the mechanical response of leveraged traders and algorithmic systems reacting to dollar strength and rising yields. When the US dollar rallies during crises, commodities priced in dollars often decline in nominal terms. When Treasury yields rise toward 4.07%, models penalize non-yielding assets, but those reactions are short-term expressions of liquidity preference. They do not negate the longer-term implications of energy shocks and monetary constraints. Consider the Federal Reserve's position carefully. Policymakers face rising inflation risk from potential energy disruptions. At the same time, higher energy costs threaten consumer spending and economic growth. Raising rates aggressively into that environment risks recession. Cutting rates into accelerating inflation risks currency credibility. Doing nothing invites stagflation, the most challenging scenario central banks confront. History suggests that when systemic stress intensifies, liquidity support eventually follows. Whether labeled quantitative easing, emergency facilities, or balance sheet adjustments, the outcome is expansion of money supply to stabilize financial systems. Over time, that process erodes purchasing power. That longer arc is why precious metals matter. Short-term corrections can obscure that trajectory, but they do not reverse it. If energy prices were to surge toward $150 or $200, inflation expectations would likely rise again. Markets that currently project 2 rate cuts instead of 3 would be forced to reassess yet again. Volatility would increase across asset classes. Safe haven flows could reemerge abruptly. In those moments, price can move vertically, not gradually. Short positions unwind quickly. Traders who exited during fear attempt to re-enter. Liquidity thins on the upside, just as it did on the downside. This is where discipline becomes critical. If you hold leveraged paper exposure, you must decide whether you can tolerate swings of 10%, 15%, or even 20% without capitulating at the worst possible moment. Leverage magnifies both gains and stress. If volatility shakes conviction, the structure of your exposure may be misaligned with your temperament. Physical holdings remove the immediacy of constant pricing. They reduce the temptation to react impulsively. That does not eliminate risk, but it changes the psychological experience of volatility. For those evaluating opportunity, remember that markets rarely provide comfortable entry points during powerful trends. The move from lower price levels to above $90 occurred with significant volatility along the way. Pullbacks were sharp and unsettling, yet structural drivers remained intact. Today's decline from $96 to $83 represents a substantial retracement in percentage terms, but it exists within a broader macro environment characterized by fiscal deficits, geopolitical fragmentation, and monetary constraints. None of those forces have dissipated. In fact, tensions around energy corridors and military engagement amplify them. It is also important to recognize how narratives shift. When silver surged, headlines emphasized shortages, safe haven demand, and momentum. Now the language focuses on fading war premiums and deteriorating technical structure. Media framing follows price rather than leads it. That is the nature of financial commentary. Analysts explain moves after they occur, but underlying realities do not flip back and forth as rapidly as narratives suggest. The Strait of Hormuz being threatened is not a trivial headline that disappears overnight. Energy flows do not become irrelevant because charts turn red. Ask yourself, what would change the structural thesis? Would a brief pause in military escalation eliminate vulnerability in global energy supply chains? Would a modest shift in rate cut expectations erase persistent fiscal imbalances? Would a two-day correction invalidate years of currency debasement trends? The answer to each of those questions is no. What we are witnessing is the tension between immediate liquidity dynamics and longer-term systemic risk. Volatility may continue. Silver could retest $80. It could even probe lower levels if leverage selling intensifies. Such scenarios are possible in markets dominated by derivatives, but each additional wave of forced liquidation exhausts supply from weak hands. Once leverage resets and positioning stabilizes, the market reassesses from a different foundation. If geopolitical tensions persist or energy prices accelerate meaningfully, safe haven demand can return swiftly. The same mechanisms that drove rapid downside can fuel equally rapid upside. Ultimately, decision-making should align with time horizon. If your outlook spans days, then yield movements and dollar strength dominate. If your outlook spans years, then monetary policy constraints, structural deficits, geopolitical risk, and energy security carry greater weight. Those longer-term variables have not improved. They have grown more complex. A market that drops 13% during escalating geopolitical tension is not necessarily signaling stability. It may be signaling mechanical repositioning. The temptation during sharp declines is to react defensively, to assume price weakness confirms danger. But sometimes weakness reflects stress within the financial plumbing, rather than deterioration in the asset's underlying case. Understanding that difference is crucial. Paper markets can deviate from physical realities temporarily. They cannot override them indefinitely. When fundamental pressures build beneath the surface, eventual repricing can be abrupt. As you evaluate your own strategy, prioritize clarity over noise. The facts remain straightforward. Silver opened above $96 and fell to $83 within 2 sessions. Gold retreated from above $5,400 to around $5,300. The 10-year yield approached 4.07%. Rate cut expectations shifted toward September, with 2 cuts projected instead of 3. The U.S. dollar strengthened amid crisis-driven liquidity demand. Meanwhile, roughly 20% of global oil and gas normally transits a narrow waterway under direct threat, and military operations continue in a region central to global energy markets. Those realities coexist. Markets are processing them unevenly. Short-term volatility does not invalidate long-term structural dynamics. Whether one chooses to hold, accumulate cautiously, or reduce leverage depends on individual risk tolerance and horizon. But decisions grounded in context tend to outperform decisions driven purely by fear. History repeatedly demonstrates that periods of maximum uncertainty often coincide with inflection points. The difficulty lies in recognizing that while headlines feel overwhelming, stay analytical. Separate liquidity events from structural shifts. Monitor energy developments closely because that is where the next major catalyst may originate. Observe policy responses because central bank actions can accelerate or delay outcomes. And above all, align your exposure with your conviction and capacity for volatility. Markets reward discipline over impulse. The present environment is testing both.